Hello and welcome to Trading Insider. First of all, let me tell you that this channel is not collaborating, partnering, or related in any way to any brokers, financial firms, or anything similar. I'm not here to tell you which brokers are the best, which educational program is the best, and nothing of the sorts. I'm here to expose the truth based on my personal and professional experience in the industry. That's it. Today we're going to be talking about how stop loss and take profit orders are executed because there is a lot of confusion or actually a lot of information that clients don't know simply because brokers avoid giving this information voluntarily. Let's get into it. There are two main types of trades, sell and buy orders. A sell order is closed by a buy order, and the buy order is similarly closed by a sell order. So basically, when you close a trade, you tell the platform to place the reverse order for that specific trade. Now, when you are placing trades, you can choose market orders or pending orders. At market orders are executed at the current price. Generally, and in basic terms, that means the price that you see on your ticket order or chart, but you have to be aware that by the time you hit that buy or sell button, the price might change. So your order will be executed at that new price. When you place a pending order, the idea is that a buy or sell order will be executed only if it reaches a certain price predetermined by you. The same idea is behind the stop loss and take profit orders, which basically are pending orders meant to close a specific trade when the price reaches a level set by you. You probably have heard a lot of people saying that it's risky to trade without a stop loss and that you should never trade without one. And that is my opinion as well, especially if you're a beginner or you don't keep a very close eye on your open trades. So a stop loss is designed to limit an investor's loss on a security position. A stop-loss order specifies that a security be bought or sold when it reaches a specified price, known as the stop price. In the majority of the cases, stop-loss orders are used to prevent investors' losses when the price of a security goes against your trade, thus limiting your loss. Once the stop price is met, the stop order becomes a market order and is executed, meaning that your original trade is closed. And here's the catch. The thing that no one tells you is that it won't necessarily be closed at the price set by you. It will be executed at the next available opportunity, more commonly known as the next best price. While the term stop loss sounds perfect for value preservation, in practice it is not that great. A stop loss can fail as a loss limitation tool because hitting the stop price triggers the trade to be closed, but does not guarantee the price at which this occurs. The bad news is that it will be triggered at the next best price, which could be many points above or below. Let's say that on Tuesday, Microsoft closes at $226. After the close, they come out with their earnings report. They report higher than expected earnings that causes excitement among investors. Buy orders come flooding in. The next day, Microsoft opens at 228. Remember, the day before Microsoft closed at 226, $2 below. Since there were no trades between these prices, between 226 and 228, this will create a gap on the chart. Now let's see some examples. So let's say we have this chart right here, and say we have entered around here, we have placed a sell order. So we want the price to fall, right? To go down for us to win. In this case, let's say the price goes up, then a little bit down, and we have set our stop loss somewhere around here at this level. But as you can see, the price moves up, down, and then there is this gap. What happens with my stop loss? Did it get executed? It didn't. If it did, at what price? Now, in this case, if we don't have a guaranteed stop loss, which we'll mention a little bit later, my stop loss will be executed. It will be triggered because the price has reached this level, but this price has not hit this level exactly. It has hit this level, right? Because the price went up, it reached this level, but the price that I set my stop loss to, so the stop price, does not exist. So in this case, my stop loss will be executed because it was triggered by this level, but it will not be executed at the price that I set. It will be executed at the next best price, right? So in fact, we will lose on this trade, we will lose more than we have set. This is why it is incorrect to say that when you set a stop loss, you limit your losses. You limit them, yes, but you don't know exactly what that limit is. Because in this case, we opened the trade here and we said, I am willing to lose this, right? This difference in price. But my trade will actually be closed at another price, at the next best price after my stop loss. So in this case, I will lose this this difference here. So I actually lost a lot more than I actually wanted. In this case, actually, I will lose double what I actually planned on accepting as a loss. Now, you might be wondering, but what happens if I have a buy order and I set my stop loss, I don't know, somewhere here, and I set my take profit here? Well, the exact same thing will happen. The take profit will be triggered, it will be executed, but not at the price that I set at the take profit price. It will be executed at the next best price. So in that case, I will actually win more. So this might work against you or it might work in your favor. Now let's see another example. Here again, we have a huge gap, right? So you need to understand that a gap can happen from one day to another, like we said in the example. The price of a share of an index or whatever asset, whatever security closes at one price today, and tomorrow it might not open at the same price that it closed today. So that will create a gap in the price. It will create a gap either above or below the previous price. So this can happen, as we said, from one day to another. It can also happen during the day, either because some news came out of that company during the day, either because a natural disaster happened, either because something globally happened, either because some news went out that affects a currency in particular, so that will affect the pairs that contain that specific currency. It can happen to indices, to shares, to basically any security, right? So remember, it can happen from one day to another, from Friday to Monday, from Monday to Tuesday, and even during the day when the market is open, you can have a gap in the price. And if you have a stop loss or a take profit, and the same will happen with your pending orders, either it's a buy or a sell. The same will happen if you have set a price and that price does not exist because of a gap in the price. It will not get executed at the price you set, it will get executed at the next best price, which might be way above or way below the price you actually set. Now, there is one exception that we have mentioned earlier in the case of a guaranteed stop loss or guaranteed take profit. There are brokers that generally for an additional fee, or maybe they just have higher commissions, they're just more expensive than other brokers, they have these type of orders that are guaranteed. So if you set a stop loss and if you set a take profit at a certain price, no matter if that price exists or not, it will get executed at that price. Now, you might think, oh, that's great. I might be willing to pay top dollars for the peace of mind that my stop loss and my take profit will be executed at the level that I set. Or is it? It will get executed, yes. But think about it. That price does not really exist on the market. How can the broker execute an order if that price doesn't really exist? Did they invent the price? Yes, exactly. They will invent the price for you. If a broker can guarantee a price for you, it means they are probably B-booking you. And take a look at my previous videos to understand what B-book is. They are probably a market maker, so they are making their own prices, or at least if they're not market maker and they are working with a liquidity provider, they at least have the flexibility to quote unquote invent that price. So there's a bad side to both of these situations. Either the broker does not guarantee me the stop loss, and it means that it might not be triggered, it might not be executed at the price that I set, or it guarantees me the stop loss, but then means they're basically inventing that price. So, which is best? Should I pay more money to get a guaranteed stop loss, or should I just trade with a not guaranteed stop loss but take the risks that it might not be executed at the price I set? The purpose of this video is so that you can trade knowing the risks of trading with a stop loss, whether it's guaranteed or not. Know how they work exactly. So in the end, it's your decision if you want to pay for a guaranteed stop loss. And these days, actually, there are a few brokers that offer guaranteed stop loss and take profit or guaranteed pending orders. So the majority of them don't actually even have this possibility, and they don't even talk about this possibility. They don't even think about getting this option. There are really very few brokers that still offer this possibility. You might not even have an option with the broker that you're working with or the broker that you like to have a guaranteed stop loss or not. But if they don't have a stop loss, which will be the majority of the cases, just know that you need to keep a close eye on your trades, even if you set a stop loss and take profit. You might think, oh, I opened my trades, I set a stop loss, I set a take profit, and now I can take my mind off of it because, whatever happens, I will either get the profits that I was aiming for, or if the trade goes against me, then my loss is limited. But that is not exactly correct. So you need to know this and you need to still keep an eye on your trades, even if you have a stop loss, especially if you know that in the asset that you're trading, there's upcoming news. Or if there's a global disaster, a natural disaster, or a pandemic like right now. So you still need to keep an eye on the news and on your trades. As a bonus for this video, I will also explain what a fast market movement is. This is the exact opposite of a gap. It means that your order will be executed, whether it's a stop loss, take profit, or a pending order, will be executed at a certain price, even if that was not your intended price, but that price actually existed. So imagine in this example here, I set my take profit here, and the price does actually exist. When the price goes up, it will actually go through this level. So all these prices in between will actually exist. But that's where the name comes from, a fast market movement. The price moved so fast from here to here, for example, that the broker, the automatic system, the software that they use did not have the necessary time to execute your trade. So it executed it at a price that happened a little bit after, it might be even milliseconds, but it was so fast that the platform couldn't execute the order at your indicated price, even though that price did in fact exist. In this case, whenever you have a stop loss or a take profit triggered or pending orders triggered, you need to check if they were executed at the price that you set. And if they didn't get executed at the prices that you set, then you need to look back on the chart and see if they didn't get executed on that price level that you set because there was a gap in the chart or because there was a fast market movement. Generally, if it's a fast market movement, you might not even see it on the chart, but if you see that that price exists on the chart, so if you don't see a gap like this, it might be bigger or even smaller, but anyway, if there is a gap on the chart, you will see it. But if you don't see a gap similar like this one on the chart, but your pending order did not get executed at the level you set, that means there is an error, and most probably it's a fast market movement. But either way, whether it's that or not, you should definitely contact your broker and ask them why that happened. You need to understand that some brokers, even if it's a fast market movement and they know that orders were triggered at incorrect prices and those prices really existed, they won't do anything about it until the client figures it out and goes back to the broker and says, hey, what happened here? And then they will probably just adjust your trade, re-execute your trade at the correct price, or just adjust the difference in funds that you lost. But you need to remember that most of the brokers will not do this proactively. They will not check back proactively and they will not refund or re execute the orders because, hey, if the client didn't realize there was an error, then why should we? You know, that's not legal, evidently, but it is what it is. And this is something very, very common in the sector. I hope you have enjoyed and learned new things and learned how to trade more safely and more aware of how actually trades are executed. If you like this video, please give it a thumbs up and don't forget to subscribe and hit the notification bell to get a notification every time I post a new one. If you want any particular videos or you have any questions, let me know in the comment section down below and I'll make sure to answer as soon as possible. If you want to see me exposing others in the industry, take a look at my other videos. See you in the next one.